All right, so we keep on talking about recognizing revenue, but we actually haven't done a revenue transaction. At least we haven't done one in a while. We did one when we did the pencil reselling business, right? But we really haven't done any more transactions around sales. So let's think about booking a sale. So sales and receivables. That's what we're thinking about now. So sales and receivables. Okay, sales and receivables. So when I book a sale, and the only thing I care about right is the sale. I'm not worried about sending the inventory. Just focusing on the sale transaction only. That's it. Sale, receivable. Sale, receivable. Okay? That's all I'm worried about. So when we book a sale, no matter what we ended up deciding as far as revenue recognition is concerned, the gross sale, we'll put in those net sale items, but on the financial report, we'll report it down as net sales. We're going to book the gross sale. So say we were looking at that last discussion where I had sales facilitation charges. I'm going to book the full amount of the sale, and then I'm going to book these other items separately. But I'm going to report on my financial report net sales, right? So we're just going to book that gross sale of 10,000. So how do we do that? So this is their sale transaction for $10,000. We were able to recognize revenue. Our assets equal liabilities plus equity. Okay? So we book this thing, and the customer has not paid us. So we're going to increase an account called accounts receivable, AR. You might see sometimes A/R. That's going to be $10,000. And that's an increase of $10,000. We don't owe anybody anything. So nothing's happening with liabilities. And under equity, well, we have revenue. And that is $10,000. Increase, right? So now my assets equal my liabilities plus equity. In this case, accounts receivable and revenue are the two things that get booked. And every time we do a sale, that's going to happen. We have these other sales facilitation charges, like, let's bring that back up. So when we have the discount, the 1% discount, or the $500 rebate. So we're going to have the $100 discount. Right? In this case, and it's a $100 discount for this customer, I'm going to reduce accounts receivable because I'm given the discount. The customer does not owe me this money for $100, and I'm going to end up having an account called sales discounts. Right? It's an expense. That sales discount is going to make my equity go down by $100. On and on and on. All these. So we're just doing this very simple thing. So now the question is, when I'm looking at these receivables, when am I going to collect that stuff? How am I going to collect that? When am I going to collect it? And it becomes a question mark. So when we think about receivables, we've got to determine, because it's likely that I've signed this contract and I've asked them to pay us within 30 days. And I might even, if they pay me earlier, if they pay me my cash earlier, I might even give them a discount. I might give them another discount, a 2% discount. If you pay me within 10 days. Why would a company do that? Because they want the cash. I want the liquidity. these two things here, you will likely see in the contract written this way. 210 net 30. Net 30. That's the way you usually will see that. 210 net 30. Another way of looking at it is it's usually 210 net 30. Something like that. Just something to describe that if you pay me within 10 days, you get a 2% discount. Otherwise, you pay me net 30. One of the other. Again, it doesn't really matter, right? These are just terms in the contract, terms on the invoice. But now we've got to look at this. We've got to look at that along with all the other receivables. And what we are going to try to find out is, do we have customers that aren't paying us as quickly, might not pay us at all? And try to determine what's the net realizable value of receivables. Okay? And what we know is we probably have some historical data that when a receivable goes beyond 60 days delinquent, then it increases the probability that we're not going to collect it. How much that is going to depend on the organization. So we look at historical data that 0 to 30, so we just sent it to them within 30 days, there's a certain percentage that might not get collected. 31 to 60, it's a different percentage. 61 to 90, a different percentage, and then greater than 90, a different percentage, right? And we may have enough historical data where we can make a judgment call using our basic data about what we may not actually collect from our overall receivables. So we've got to figure out, how do you age this stuff, right? So let's think about that. How do you age that? So the next video that we'll do on this is using a analytic tool and a bunch of data from a company, and let's see how we might be able to age receivables, thinking about that kind of stuff.